Welcome to Srihari's lessons. Hope you enjoy your time here. Continue listening and supporting. Hello friends. Let us discuss about accumulating surplus and managing surplus in this chapter. We have seen about managing income and managing expense in previous videos. It is quite a simple logic that if income is more than expense, it is surplus. If expense is more than income, it is deficit or shortfall. It is a result of your income and expenses and action towards income and expense. What more can we discuss about surplus or deficit? Each individual will have different aspects involved in income generation, like source of income, quantum of income, periodicity of income, etc. Same way, each individual will have different aspects of expenses in their way of life depending on their current stage of financial journey. And the surplus we are going to discuss is a result of individual income and individual expense. However, there are far too many variables involved in creating or managing surplus when discussed as a whole audience in generic context, and the relatable effect on each individual shall be different. If expense is more than income and there is a deficit, the action required is two-pronged. On one side, you have to increase your income, and on the other side you have to cut down your expenses. This is very easy when said, but extremely difficult when you actually do this. As we have seen in earlier videos, in general context, both increasing income and reducing expenses have a limit depending on one's circumstance. Let us start with income side. We have to look at three broad categories of people for this discussion. There are some people who inherit wealth and in turn inherit income. The second set of people, those who have acquired enough education and professional profile. In other words, skill sets which can help generate income. The third category are the ones starting from scratch without any basic foundation for income generation. These are the three categories. Even within these three categories, there are various levels under each category. For example, in second category of people with enough skill sets, there are professionally qualified people like doctors, engineers, and among them there are people with different specialization and even with different number of years of experience. Let us once again remember, each individual is different. Perspective for increasing income is entirely different for each of these categories. Let me put up some probable options on this. For the first category of inherited wealth, you should reassess the available passive income sources and look for sources with higher returns. The second category shall look for something like a professional diversification and multiply sources of revenue. The third category shall look for improving skill sets to increase their income. The three categories need not be applied separately for each individual, but it will be a mix of two or three applicable for all individuals. In practical world, the actual increasing income shall happen by mixing two or all three categories depending on individual circumstances. For each individual, using simple probability theories, there are three categories of sources of income multiplied by avenues of income in each of the category in front of them as available options. Further, for each individual, these probable options will modify at each stage of their life, like their age, status of career, family structure, geography, etc. Just imagine how many variables are working based on the above options. That is why increasing income is easy to say in words and difficult when actually implemented. Out of so many options available, each individual has to choose the option right for them at that point of taking the decision. Same way, expenses depend on way of life of people, and therefore reducing expenses depends entirely on the way of life, which in turn depends on various aspects built into way of life. For example, if an individual has to support a family, size and status of family decides the quantum of expenses. Reducing basic expenses is practically impossible if you have designed your expenses based on the needs pyramid structure. Anything not as per your own pyramid are most times unwanted expense, and they are the only ones that you can target when trying to reduce your expenses. However, one has to be very careful when deciding something as not part of pyramid and unwanted. When there is a deficit, you have to work on increasing the income, at the same time controlling the expense. When we say controlling the expense, it does not mean one has to forego dreams or lose hope. This will mostly be a temporary compromise by postponing certain elements of their financial plan. There are actually two major branches or categories of expenses in the financial plan or a needs pyramid. As explained in expense management video, each individual should identify their expenses based on their current circumstances and classify them in a pyramid form. The classification in the pyramid can be based on importance of the need at the present time. That means futuristic expenses are treated differently in the pyramid. To put in other words, the classification of pyramid not only means importance but also time frames. A future expense may be important, but at the same time there is no need for allocation of money in the present. That should also be built into the pyramid. As a result, the pyramid will have two branches. In addition to considering classification based on importance, time frames should also be kept in mind. Please remember importance of expense and time frame of expense. First branch should be expenses that have to be met today. That is, day-to-day living expenses like food, rent, etc. Monthly expenses like telephone bill, electricity bill, etc. The second branch is that pertaining to longer term needs for which you have to accumulate and save money to meet those expenses at a future date. For example, we can take the example of parents planning for kids' higher education expense when the kids are just born. What will be this future date and what are the expenses that can be kept for future has to be made clear in the pyramid. The money allocation for both these will be psychologically different to approach for any individual. What is for the present, what is for the future, in addition to being driven by circumstances of each individual, will also be entirely driven by psychological or behavioral pattern of each individual. The financial need pertaining to second branch or allocating for future expense cannot be technically called as deficit. Since the expense is for a future date, you actually do not need money today to meet the same. Therefore, it cannot be called as deficit. However, if there is any lacuna in sticking to those expenses and the plan, when you reach that future date, you may end up with not having any source of funds to meet the expenses when the date of spending comes up. This is where financial discipline plays a vital role. The missteps happening in this part of management is where majority of indiscipline happens in financial journey. When looking at the first branch or allocating money for the present day expenses, there is a real deficit. Case in point is about managing deficit over the period until it turns into surplus. The shorter this time frame, it is better, and that should be the target, right? However short this period is, this can only be managed by borrowing the required money to bridge the gap. However, any borrowing in life should be done only when you know the impact of that borrowing in your financial plan. You should borrow money only to the extent of how much you can repay. This is integral part of your financial plan and financial discipline. When you overcome any scenario of deficit and when the result is surplus, there is even more action required. The first and foremost action required is to ensure the surplus is sustainable and consistent over a long run. When we say consistent, it does not refer to the quantum or periodicity. It is more about the process consistency and regularity of actions. The accumulated surplus should be carefully kept aside and put in a proper place of growth with the two possible goals. One goal should be to make this accumulated and grown up surplus to be available to meet a future expense at a future point of time. Second goal should be to make this accumulated and grown surplus to form an asset base to support your financial independence through passive income generation. The tools or avenues to accumulate this money, which is loosely called in today's financial world as investment options, is common for both these types of goals. Please note that by saying the words investment options is a loosely used word in today's financial world, I am disagreeing only with the way the word is generally used or misused. According to me, investment is one when you do not attach a probable sale or liquidation when you put money into the same. The intention may be to generate income or reduce expenses on a permanent basis. Whenever the intention is to grow money, then exit and withdraw that entire money, then it cannot be called as investment. We may call it as trading. Both these are putting money with an intention to get returns or grow the asset value. However, the exit option is where you decide whether it is an investment or trade. The meaning explained by me is for the purpose of way of life and personal finance planning. When you look at taxation, income tax, or marketplaces, or banking purposes, the context of using the words should be the way it is accepted by the world. Now, accumulation journey is different for each individual. Based on individual financial goals, financial plans, long-term vision, the journey will differ from individual to individual. Based on different stoppage points, different goals in the financial journey, and the quantum of surplus available, one has to make financial decisions. In earlier video, we have fixed a name financial journey. Now we are bringing a new word, accumulation journey. Yes, accumulation journey is a part of financial journey, like a mini journey within. We repeatedly say money makes money. The money making money gets actually translated into wealth generation. The wealth thus created is what can give entry ticket to financial independence. Yes, I repeat, wealth is what allows us to reach financial independence. Even if you have high and more than sufficient income, it does not really mean financial independence. If the source of income is diluted, our financial independence is lost. Therefore, we have to create wealth which have to in turn generate regular and consistent income or ensure reduction of expenses which will give us financial independence. Managing of deficit or creating a surplus is only a result. Therefore, action or management is only about handling income and expense. All these elements we have discussed so far are all part of financial plan. In every stage of the journey and periodically, your financial plan will have elements of income, elements of expenses, and your needs pyramid. The concept does not change irrespective of whether you are facing deficit, creating surplus, accumulating surplus, or you are financially fully settled and independent. The difference is in your actions and reactions at different stages of life and different stages of financial journey. Therefore, all the points we have discussed so far are pertaining to actions and reactions required or suggested. It is important to understand that creating surplus is only one part of financial journey, but at the same time it is the most important part of the journey. This is when accumulation journey begins and financial journey becomes active, meaningful and starts driving your life. There is a lot to discuss in respect of various ways in which accumulated surplus can be converted into wealth generation. In subsequent chapters, we will discuss accumulation journey in detail, touching upon various tools or options available to put your accumulated surplus to result in wealth generation. These are the points pertaining to accumulating and generating surplus, covering creation of surplus, turning deficit into surplus, go through investment journey, leading to wealth generation, and in turn financial independence. With that, I'll close this. We will see you in the next video. Thank you. Welcome to Srihari's lessons. Hope you enjoy your time here. Continue listening and supporting.